Virgin Australia is feeling the impact of COVID-19. There's no doubt about that.
Virgin Australia has just gone into voluntary administration.
Bain Capital has bought Virgin Australia.
After 24 years of flying, Virgin is floating.
Virgin Australia's relaunch on the Australian Stock Exchange has been a long time coming.
Virgin's had quite the ride over the past 5 years. It was the first airline to go under during COVID, got snapped up by an American private equity giant, landed an investment from Qatar Airways, and this week made its comeback on the ASX as Middle East turmoil whipsawed markets. So what is next for Australia's second biggest airline? Hello, I'm Rebecca Jones and welcome to the Bloomberg Australia podcast. Today we dive into the Virgin Australia IPO, the biggest listing on the ASX so far this year. Well, it is technically a relisting, if we're being precise, to examine what its return means for investors, consumers and the airline industry. I'm joined by Angus Whitley, global business reporter for Bloomberg News, who writes about aviation and has spoken this week to the company's new CEO. Angus joins me today from Sydney. Angus, I'm going to try and lay off the flying puns, and I will commit to that, but just let me sneak in one more. The last 5 years have been pretty turbulent for Virgin Australia. Can you give us a potted history of what's happened since the dark days of 2020?
The dark days of 2020 really were the start of the pandemic, weren't they? I mean, Virgin Australia did not last long when the pandemic grounded global aviation. It was saddled with debt, and once it couldn't fly anywhere, it really couldn't service the debt. So it was paralyzed. So Virgin went under. Attempts to seek government help failed, and you remember Qantas CEO Alan Joyce at the time lobbied against that. So it was cutthroat. It was cutthroat stuff. There were layoffs. Since then, Virgin Australia has gone through 3 different CEOs. They've undertook years of planning for the IPO through their majority owner Bain Capital at the time. There was at least one false start, one failed attempt to list when the listing window closed. And now we're here. So they're stringing together consecutive profits. They recorded their first profit in 11 years, would you believe, in 2023. So this was not a company that made money on any regular basis before. And now they're set to record 3 annual profits in a row. So they've come a long way since those, as you say, dark days of 2020. And it's a pretty different airline.
Of course, shares have just started trading on the Australian Stock Exchange on Tuesday afternoon. Angus, how did they go on day one and what does that tell us?
Yeah, Bain Capital, which still owns about 40% of Virgin Australia, sold a 30% stake in this IPO at $2.90 a share. And the stock closed at $3.23. So that was a 11% pop in the first day, which, that's pretty good. That tells us that Bain left something on the table, as they say, for the new investors. But also, I think it's a remarkable result, really, when you think of how they managed to thread this needle and get the IPO away, given all the developments, the fluidity, the fast-moving developments in the Middle East that was really, affecting global sentiment. Doesn't matter whether you're an Australian airline or an Australian company. The IPO was hours after Iran's retaliatory strikes in Qatar, and just hours after the ceasefire, Trump's announced ceasefire between Israel and Iran. So if they'd started trading a few hours earlier, it could have been a different story. But things really did fall for them. That's why they got an 11% pop.
And we're recording this on Wednesday. And of course, things are still quite volatile and we could be in a different situation, right, when this episode comes out on Thursday. I am interested, Angus, in the word on the street. Is it supporting this narrative, Bain being the smartest kids on the block here, right? Are the analysts telling you that the IPO valuation is about right, or do they think it's overvalued?
Yeah, good point. I mean, you're buying an asset off a private equity company. There's lots of pitfalls there. That they know the asset better than anyone. And if you're a new investor coming, you don't know anything about the asset, really. All you know is the prospectus. It's a bit like buying a secondhand car.
Yeah.
You might have the service record, you'll have the price, and you'll know the owner, you have a prospectus. in the sense of an IPO, but you don't really know too much about the inner workings of the company. So that's what puts people off buying assets from private equity, because they've stripped out costs, which Bain has in the case of Virgin Australia, and it's a good time for them to sell. Does that make it a good time to buy? That's questionable. However, the Australian analyst community is largely full of bulls. If you look at the analyst ratings for Qantas, for example, there's only one seller, and that's Morningstar. And that's partly because it's a duopoly. Qantas and Virgin largely share the entire market. And if you can't make money in a duopoly, you're doing something wrong. So was the IPO valued? I think the trade on the first day tells us something. The spoils were probably evenly spread between Bain and the new investors. I mean, Bain raised more than 600 million Australian dollars. The investors made a more than 10% return in a day. It's too early to say what the market thinks of Virgin Australia stock now. We've only got one analyst rating on the terminal. That's from CLSA. They have an accumulate rating, but the stock is already above CLSA's target price. So time will tell, but it's very early days. But from the first day's performance, I think both Bain and the new investors were pretty happy.
I want to talk about oil prices, because oil prices in the aviation industry, they're inextricably linked. We've seen those prices tumble this week as tensions have appeared to ease in the Middle East. But, as I said before, it's still a very volatile situation over there. And these sorts of crises can hit the global demand for travel, not to mention Virgin's significant ties to the Gulf region via its Qatar Airways stake and long-haul flights to Doha, etc. What did the newish CEO, Dave Emerson of Virgin Australia, have to tell you about that when you spoke to him?
Dave Emerson is the new CEO, and actually this was his first outing with media on Monday. He'd been really working pretty hard on the IPO. I think hadn't met the media. I spoke to him on Monday night on the eve of the IPO, when Middle East tensions were really at a peak. And actually, it's one of my first questions: how do you feel about listing in this kind of environment? So it is true that Virgin Australia has deep ties to the region. I mean, Qatar Airways owns 25% of the airline. Virgin Australia runs its long haul routes into Doha using Qatar Airways aircraft. And that's how it advertises itself as a kind of Australian airline that offers long haul connections. But at the same time, it's a low risk, low return strategy, because Virgin Australia is not running its own aircraft. It's not getting huge returns. That connection with Qatar really serves to feed customers on to Virgin's domestic network. And that's where Virgin likes to make money. It's where it does make money. And why wouldn't you? You're part of a duopoly. Much better for Virgin to compete in the domestic market than it is in the international market. So that's one aspect of that Middle East ties. Now, Emerson said, of course, if this lasts for more than 6 months, then it starts to have an impact on all airlines. Oil prices might rise. That would hurt all airlines. It's usually the first or second biggest cost for any airline. But for the moment, Virgin Australia is actually pretty well hedged for fuel costs for the next 6 months. So he was pretty pragmatic about listing in this environment. His words were, well, that's aviation. And of course it is. Aviation always goes through these geopolitical ruptures, doesn't it? And it always seems to come out the other side somehow, because people still want to fly.
Angus, you've covered Australia's airline industry for more than a decade, and we know that last time Virgin was listed on the ASX, it had a bit of a tough time. What now do you see as the biggest challenges it faces this time round, given the variety of concerns about the global airline industry right now?
Yeah, it did have a tough time, didn't it? I mean, I think that's putting it mildly. The stock hardly ever traded, relatively. And I don't think it rarely traded above the offer price as well as a publicly listed airline. So I think that the big challenges it faces right now is managing this environment and showing it can sustain profits through what, frankly, are pretty good conditions at the moment. There's a shortage of capacity worldwide, so airlines cannot get enough aircraft. The manufacturers can't pump them out fast enough. That allows airlines, including Virgin Australia, to charge a premium for seats and to fill their aircraft, 85% full as they are at the moment. That's a pretty good, what they call a load factor. That's any airline would settle for that any time of the year. The question is, can it do that when things are not in its favor? Can it sustain that position when perhaps aircraft come back onto the market in a few years' time? Can it continue to charge the right prices when there's a bit more competition in the market, for instance? And let's not forget, Virgin has capitalized on the lack of competition here. We've seen the collapse of Bonza and Rex as well, and that has served to boost Virgin just at the right time, really, before their IPO. So that has to some degree not inflated profits, but certainly boosted them. The question is, can they do that when there's a bit more competition and things aren't so much in their favor?
And when we come back, we'll unpack what the listing means for both investors in Virgin Australia and us, its passengers. I'm Rebecca Jones, and you're listening to the Bloomberg Australia podcast.
We're generating strong returns, and we're able to fund our fleet growth without needing new equity. It's different in almost every way as far as the business model goes. So we're very now focused on serving the domestic Australia market.
And welcome back to the Bloomberg Australia podcast. You're here with me, Rebecca Jones, and I'm talking to Angus Whitley, a reporter for Bloomberg News who covers the aviation industry. Angus, we just heard there from Dave Emerson talking on Tuesday about Virgin's improved balance sheet and its focus on domestic routes. How is Virgin positioning itself to take market share off its sworn rival? Should Qantas be worried?
Well, do you know what? Bizarrely, it's not really trying to take market share off Qantas. There's been this long sort of ceasefire, if you like, between Virgin and Qantas, where they would just allow each other to have, a third of the market in Virgin's case and 2/3 of the market in Qantas's case, and that was very good. Broadly, leave each other alone and just carve up the market in those kind of proportions. So I asked Dave Emerson when I spoke to him on Monday, I said, you've always been satisfied with a third, and his predecessor said she was going to draw the line at third as well. And he says, we don't need to take more market share. We just need to take more profit. So when you think about the market share, Qantas packs way more of a punch when it comes to profit. Qantas's profit is, has been in the 90s, 90% of what you call the profit pool in Australia. And Virgin's profit share is in the 20s, Emerson told me. So what he would like is to get that profit share to the same level as the market share. So about a third of the market share, a third of the profit share. And that means competing where they've got pricing power. And so this time round, we've seen Virgin really let Qantas have the bottom of the market, Jetstar. You can have the low-cost fares. We're not going to be able to compete with you on that segment. And it's pretty much given Qantas the top of the market as well, the premium corporate customer. You can have that as well. We're not going to be able to compete in that segment either. But what Virgin thinks it can do is plow through the middle ground. So it's looking for the small business customer, the premium leisure, the value-oriented, in Emerson's words, corporate customer that actually, to those companies, every dollar does matter. It's not just the big corporates who have an account with Qantas. No, we'll fly with Virgin because we're a bit more value conscious. And so in that respect, Virgin's challenge is really about maximizing the profit in the segments where it's competing.
So let's look at this now from a shareholder view with those two airlines competing in this duopoly space. What does Virgin have to offer shareholders this time round compared to what Qantas has got at the moment?
I don't think it's terribly complicated. I mean, what do all investors want from a stock? They want sustainable, repetitive profits, a bit of growth, dividend, But I think in Virgin case, I think the shares probably have to be a bit cheaper in relative terms than Qantas. Otherwise, if you're an investor in Australian aviation, why don't you just buy Qantas? It's the biggest carrier in the world. It's more diversified. It's got pricing power. It's got different brands. It's minting money at the moment. So I think, it's all about price. I know it's a cliche, but it is about price. If you're delivering sustainable profits that are getting bigger and delivering what you say you were going to do, then I think Virgin shareholders will be satisfied with that.
Finally, how much does the loyalty business of both carriers come into this equation? Obviously, that's something that we've seen Vanessa Hudson, once she's taken the reins from Alan Joyce, really rethink that strategy completely. Should we be expecting any changes under Emerson at Virgin now that they've listed?
It's worth, I think, pointing out just how important loyalty businesses are to airlines. They are really the glue that hold the business together. They're very often the most profitable part of the business, even though they don't have any passengers, no aircraft. They're fast growing. Sometimes they have a value that's not far off the value of the airline itself. If you look at in some of the analysis of the best loyalty businesses in the planet, and I would have to say Qantas probably has one of them. So this is really hard for Virgin competing with Qantas Loyalty. It's an absolute behemoth in the Australian market. Qantas Loyalty is, when I say the glue that holds the airline together, Qantas Loyalty is strong enough to really keep people flying with Qantas, no matter what it does to them. Because if you're collecting Qantas points, you will forgive poor service, which any airline does deliver at some point. So if you had a bad experience with Qantas, you'll probably keep flying with them because you're collecting the points. So Virgin's challenge is really to get to that state where its passengers are collecting uniquely Velocity points. And that's Virgin's frequent flyer program, Velocity. And that's a tall order. And just to give you a few numbers, if you look at the revenue of Qantas, frequent flyer and Velocity, it's about 3 billion Aussie dollars together. That sounds pretty good, right? In a year, until you break out Virgin's share, not much more than 400 million. And then when you look at the number of members, Velocity has 13 million, Qantas has 17 million. So if you look at that disparity between the revenue share and the members, it's really huge. It's fair to conclude that Velocity is not packing a punch per user, right? So its challenge is really to get those 13 million members more engaged, more uniquely chasing Velocity points. And that's a tall order, because really Qantas has that market wrapped up, I think, in Australia.
Angus Whitley, thank you for joining me.
Thanks, Beck.
If you found today's conversation insightful, be sure to follow the Bloomberg Australia podcast wherever you listen, and check for more reading on Virgin, Qantas and the business of travel, including the latest reporting from Angus Whitley on Bloomberg.com. This episode was recorded on the traditional lands of the Wurundjeri and Gadigal people. It was produced by Paul Allen and edited by Chris Burke and Ainsley Chandler. I'm Rebecca Jones, and I'll see you next week.